Hi, dear traders. The latest data on inflation in the United States made markets uncertain about the next step of the American regulator. There is now a lot of speculation about what the Federal Reserve will decide at its next policy meeting. On Friday, markets closed mixed amid the release of the Producer Price Index data, which intensified expectations of another rate hike by the Fed. In addition, the Fed policymakers confirmed their determination to fight inflation until it stabilizes near the target level of 2% and until the labor market becomes balanced. The US dollar was in high demand last week, driven by the hawkish sentiment. As a result, the US dollar index approached a 5-week high of 102.80, recording its fourth consecutive week of growth. On the flip side, the recent macroeconomic data shows some slowdown in the recovery of the U.S. economy. Besides, there are signs of a banking crisis and the resumption of geopolitical tensions between the U.S. and China. Yet, the defining factor for the market remains the decision of the U.S. Central Bank regarding its interest rate. Even the single European currency came under pressure. Thus, the euro-dollar pair closed last week with a decline at the level of 1.0950. Meanwhile, it seems that in the euro area there is also no consensus as to how the policy of the European Central Bank will change. Is there another rate increase coming? ECB President Christine Lagarde mentioned previously that the regulator would pause the tightening cycle in September, or it might also consider a rate hike depending on the situation. In the meantime, the incoming economic data from the Eurozone indicates a downbeat state of the European economy and Germany in particular. The British pound also retreated against the greenback and rolled back from the monthly highs where it ended up thanks to strong economic data from the UK. Investors are sure that the Bank of England will continue to raise rates as inflation remains stubbornly high, but at the same time the economy is stable. The pound-dollar pair closed this week below the price area of 1.27. As for the Japanese yen, it continues to test the key resistance level of 145 against the US dollar, which is not a good sign for the Japanese monetary authorities. Last autumn, the central bank intervened in the foreign exchange market when the yen was hovering close to those levels. However, Bank of Japan Governor Katsuo Ueda issued a statement saying that the policy adjustment is not a step towards policy normalization. Therefore, no interventions should be expected anytime soon. Gold is very sensitive to all speculations regarding a possible rate hike by the Fed. When interest rates are high, investors turn to government bonds as a more preferable store of value. So, given the hawkish rhetoric prevailing in major central banks, the precious metal is quickly approaching the level of $1,900 per troy ounce. Meanwhile, oil is gaining ground and is trying to break above its current trading range. To do this, Brent crude will need to break through the mark of $88 per barrel. From the fundamental point of view, there are no factors that help clearly define the direction of oil prices. Thus, OPEC predicts an increase in energy demand, but the International Energy Agency sees a decline. On the supply side, there is a very sluggish recovery in the largest oil importer, China, while oil supplies from Saudi Arabia and Russia stay limited. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!